There is one single word in the English language that absolutely destroys our critical thinking. When a corporation offers you something for free, your guard should immediately go all the way up. We all know this rule applies to social media, search engines, and shady online sweepstakes. But for some reason, when Wall Street offered us free trading, we completely forgot the golden rule. Let me ask you a very simple, yet deeply uncomfortable question about your brokerage account. If your stock trading app does not charge you a commission, how are they making billions of dollars? Because they are making billions, and they are doing it by treating you like a financial piñata. Welcome to the beautiful, incredibly profitable, and completely invisible world of payment for order flow. Before the year 2019, investing in the stock market was a very deliberate and calculated process. If you wanted to buy shares of a company, your broker would charge you a flat fee to execute. That $10 fee acted as a psychological speed bump, forcing you to actually think before you blindly clicked buy. You did not day trade your tiny account, because the commission fees would mathematically eat you completely alive. But then, a wave of disruptive tech startups arrived with a massive promise to democratize the financial system. They completely eliminated trading commissions, and suddenly, the entire industry was forced to aggressively follow suit. The mainstream media celebrated this as a monumental victory for the everyday retail investor. We were told that the gates to Wall Street had finally been kicked open for the working class. But Wall Street does not do charity, and they certainly do not give up their revenue streams without a fight. They simply took the fee that was sitting right in front of your face and hid it under the table. Which brings us to the actual mechanism of how your supposedly free stock trade is being aggressively monetized today. Let's say you want to buy 100 shares of a trending tech company on your mobile phone. You press the green buy button, and a little animation plays to celebrate your ultimate financial genius. You probably assume your broker just sent that buy order directly to the New York Stock Exchange. But that is not what happens, because your broker actually sold your order to a high-frequency trading firm. These massive algorithmic firms are called wholesalers, and they act as a hidden middleman for your trades. They literally pay your broker for the exclusive right to execute your trade against their own private inventory. Why would a sophisticated quantitative trading firm willingly pay money to handle your tiny emotional retail trade? Because retail traders are considered uninformed, entirely unpredictable, and highly lucrative flow for these massive market makers. They know you do not have insider information, and they know you are probably trading based on a Reddit post. So they gladly take the other side of your trade, pocketing a tiny fraction of a penny in the process. It all comes down to a very boring, yet incredibly important financial concept known as the bid and ask spread. When you look at any stock, there are always two prices: what buyers will pay and what sellers actually want. The difference between those two specific numbers is the spread, and that is where the wholesaler makes their fortune. If the spread is just one single penny, the wholesaler captures a tiny fraction of that penny on every trade. A fraction of a penny sounds completely harmless, maybe even like a fantastic deal for the amateur retail investor. But when you multiply that fraction by billions of shares traded every single day, it becomes an absolute goldmine, because right now, just two massive high-frequency trading firms execute more retail trades than the actual public stock exchanges. Firms like Citadel Securities and Virtue Financial are the invisible puppet masters of the modern retail trading ecosystem. During the peak of the recent trading boom, Citadel alone was executing roughly 27% of all United States equities. That is a terrifying level of market concentration, giving one single firm unprecedented access to global retail trading data. And they use this massive informational advantage to constantly refine their algorithms and perfectly predict market micro-movements. Let's talk about the standard defense that the brokerage industry uses to justify this entire controversial payment arrangement. The brokers will loudly claim that payment for order flow actually provides retail investors with significant price improvement. They argue that the wholesalers give you a slightly better execution price than the public exchange would have offered. And mathematically, they are technically right, but it is one of the most brilliant statistical illusions in modern finance. Imagine I am selling you a used car that has an official public market value of exactly $10,000. But instead of letting you see that true public price, I secretly quote you a price of $10,050. Then, I generously offer you a $20 discount, bringing your final execution price down to $10,030. I will look you straight in the eye and proudly boast about the incredible $20 price improvement I just delivered. But you still fundamentally overpaid by $30, and I get to walk away looking like the ultimate financial hero. That is exactly how wholesalers use the opaque bid. Ask spread to extract billions of dollars from the retail market. And the sheer scale of the revenue generated by this invisible spread extraction is almost impossible to fully comprehend. In a single calendar year, major retail brokerages collected over $3 billion strictly from routing your orders. That is $3 billion that quietly evaporated from the accounts of retail traders without them ever even noticing. Because when a fee is explicitly charged as a line item, consumers get incredibly angry and demand immediate financial transparency. But when a fee is invisibly baked into the execution price of the asset, consumers blissfully ignore it entirely. This invisible extraction model completely changes the structural incentive of every single retail brokerage platform in the entire country. In the old days, a traditional broker made money when you carefully built a sustainable long-term investment portfolio. They wanted you to actually grow your wealth, because a wealthy client would continue to pay management fees indefinitely. But a zero-commission broker does not care if your portfolio grows, shrinks, or completely implodes overnight. Their entire business model is completely detached from your actual financial success or your long-term wealth accumulation. They only make money when you are actively trading, which means they need you to be constantly highly stimulated. Meet Dave, our favorite optimistic retail trader who just discovered the dopamine-fueled world of high-frequency options trading. Dave downloaded a brightly colored brokerage app because it promised to democratize finance and empower the little guy. He thinks he is a modern financial revolutionary, tearing down the establishment one highly leveraged meme stock at a time. But Dave does not realize that the financial establishment actually built the beautiful digital casino he is currently sitting in. Every time Dave furiously buys and sells his options, his broker gets a massive financial kickback from the wholesaler. And options contracts have much wider spreads than stocks, meaning the hidden middleman extracts even more devastating invisible fees. This is exactly why these apps gamify the trading experience, pushing notifications and trending daily lists to your home screen. They do not care if Dave makes a massive profit, and they do not care if Dave loses his entire life savings. They only care that Dave keeps pressing the buy and sell buttons as frantically and consistently as humanly possible. If you think this system of routing trades away from public exchanges is a brand new digital innovation, think again, because history does not repeat itself, but it almost always rhymes when there is massive amounts of money on the table. In the late 19th and early 20th century, the American financial system was heavily plagued by notorious bucket shops. Bucket shops were essentially unregulated urban storefronts where everyday people could come in and recklessly gamble on stock prices. But when you placed a trade in a bucket shop, you were not actually buying the underlying stock certificate. The shop owner simply took the other side of your bet, keeping your trade completely off the official public exchange. They thrived on retail incompetence, knowing that the vast majority of amateur traders would eventually blow up their personal accounts. If you were actually too good at trading, the bucket shop manager would simply ban you from coming back inside. They only wanted the dumb money, the uninformed flow, the desperate people who traded purely on hype, rumors, and emotion. Now, I am not saying that modern free trading apps are legally classified as unregulated historical bucket shops, but the structural incentives, the predatory appetite for retail flow, and the underlying business models are uncomfortably similar. Think back to the great meme stock rebellion of 2021, when retail traders genuinely thought they beat the system. The media painted it as a brilliant populist uprising, an army of internet users destroying billionaire hedge fund managers. But if you look at the actual math, the real financial winners of that mania were the high-frequency algorithmic wholesalers. During the absolute peak of the trading frenzy, retail volume exploded to completely unprecedented and entirely unsustainable historical levels. And because the volume exploded, the revenues generated through payment for order flow absolutely skyrocketed right alongside it. The financial elites did not lose the meme stock war. They literally monetized the entire populist internet revolution. They built a beautiful, frictionless digital toll booth and convinced an entire generation of naive traders to sprint right through it. And that brings us to the most dangerous financial weapon that has been handed to retail investors today. I am talking about the explosive rise of 0 days to expiration options contracts, commonly known as 0 DTE. These are highly leveraged financial derivatives that expire completely worthless at the exact closing bell of the daily trading session. They are essentially volatile lottery tickets with a ticking time bomb attached, specifically designed for maximum daily adrenaline. A few years ago, these hyper-speculative options instruments were barely a noticeable blip on the broader institutional market radar. But today, they consistently account for roughly half of all options, trading volume on the entire Standard & Poor index. Retail traders love them because they offer the intoxicating, dangerous illusion of getting incredibly rich in a single afternoon. But the house loves them even more because the hidden spreads on these short-term contracts are absolutely massive. Every time a retail trader blindly rolls the dice on a 0 DTE contract, the hidden middleman collects a premium. It is a volume-driven cash machine that relies entirely on human impatience, emotional greed, and the illusion of financial control. And it proves that the financial markets have slowly transitioned from a capital allocation mechanism into a global digital casino. If all of this sounds like it should probably be strictly illegal, you are definitely not the first person to notice. In fact, payment for order flow is heavily restricted or outright banned in countries like the United Kingdom and Canada. European regulators looked at this lucrative business model and correctly concluded that it creates an entirely unmanageable conflict of interest. They decided that brokers should not be legally allowed to auction off their own clients to the highest algorithmic bidder. But here in the United States, relentless Wall Street lobbying has ensured that this lucrative practice remains completely dominant. The Securities and Exchange Commission has occasionally threatened to crack down on the system, but nothing ever fundamentally changes. Because the industry heavily argues that without this system, the glorious modern era of free trading would instantly come to an end. They threaten that, if payment for order flow is banned, they will be forced to bring back those $10 execution commissions. And absolutely nobody wants to go back to paying commissions. So the regulators quietly back down, and the digital casino stays open. So, if the entire underlying plumbing of the stock market is specifically designed to scalp your trades, what do you do? How do you survive in an environment where your own broker is financially incentivized to encourage your absolute worst habits? Here are a few practical, boring rules to keep you from becoming just another profitable statistic for the high-frequency algorithms. First, you have to completely eliminate the toxic idea of active day trading from your overall wealth-building strategy. You cannot consistently trade a supercomputer that is located 3 miles from the exchange and processes data in actual nanoseconds. Second, you must always use strict limit orders when you are buying or selling any financial security on a free app. A market order is essentially handing the algorithmic wholesaler a blank check and politely asking them not to absolutely rob you. A limit order puts a firm, undeniable ceiling on your price, immediately cutting off their ability to exploit the hidden spread. Third, you need to deeply recognize that pure boredom is actually the ultimate superpower when it comes to long-term investing success. If your daily investing strategy feels incredibly exciting, adrenaline-fueled, and highly entertaining, you are almost certainly doing it completely wrong. Wall Street aggressively wants you to be entertained, because an entertained emotional trader is an active trader who constantly generates hidden fees. Which brings us to the uncomfortable truth about the democratization of finance and the widely celebrated free trading revolution. Making the stock market completely free and totally frictionless did not level the playing field for the average retail investor. It just removed the very last psychological barrier that kept normal, hard-working people from gambling away their entire life savings. When you had to pay $10 to execute a simple stock trade, you actually sat down and critically thought about it. You did the proper research, you calculated the downside risks, and you only pulled the trigger when you were absolutely certain. But when trading became completely free, it seamlessly transitioned into a low-stakes video game, with absolutely devastating real-world financial consequences. The financial industry brilliantly realized that the absolute best way to extract generational wealth from the working class was incredibly simple. Just tell them they are sophisticated, revolutionary investors, hand them a free mobile app, and let predictable human nature do the rest. So I genuinely want to hear where you firmly land on the current state of our frictionless, heavily gamified financial system. Do you think a payment for order flow is a completely harmless innovation that actually lowered trading costs for everyone involved? Or do you think B, it is a brilliant structural scam deliberately designed to quietly siphon wealth from the disappearing middle class? Drop your honest take in the comments section below, and let's see how genuinely split everyone really is on this controversial topic. And always remember, if the digital financial service is completely free, you are definitely not the investor. You are just the inventory.